For many of you, busy season is finally over and we're entering the winter months where demand drops by up to 50% in a lot of markets. And honestly, it's at a horrible time because the housing market is beginning to break. Let's dig in. One of the things that we're seeing that's really concerning is that we're seeing great financial crisis levels of Treasury bond rates. This is the U.S. government 30-year Treasury, which has spiked all the way from the bottom of 2020 at 1% all the way to above now 5.3%. This is pushing yields higher as the people and the bondholders are saying, hey, the government is not taking our debt seriously. They're having to refinance a lot of debt, a lot of short-term debt, and there's not as many buyers showing up to the auctions. And this could end up being some sort of credit crisis that we could see rates go even higher. And we're already in an affordability crisis right now with buyers who can barely rub two nickels together to buy a house. So if we see interest rates continue to move up from here, it could be a really dangerous situation for the housing market, which is already starting to see some distress, which I'll share with you at the end of the video. But right now, what we're seeing on mortgage rates is we're seeing up to 6.75, 6.85% rate, which obviously is pushing the affordability over a cliff at these record high prices, and sellers need to wake up. I tell a lot of sellers right now, do the math of what the monthly payment is to buy your house today at the price you want to sell it versus when you purchased it. See what that difference is and ask yourself, is the next generation going to actually be able to purchase that house? Because for the majority of homes, they fit in that middle 80% bucket. Price points that the middle class can no longer basically afford and keep up with, and that includes taxes, insurance, all the other things that come along with it, maintenance and repairs that drive prices of home ownership a lot higher than what you could do to rent the similar house. So this is a 10-year Treasury. Obviously, we saw a low down here in March, and it's been jumping about 70 basis points since then, and it likely is going to continue moving up because the government and the Fed are not really taking seriously the amount of debt load that we have, and bondholders are reacting. Meanwhile, we have inflation kind of peeking its head back up again due to the monetary policy. There's some Wall Street banks out there who say that we might see a rate hike between now and the end of the year. We'll have to see what this Fed decides. I know they have been all over the board. They're changing how they calculate inflation. They're having these conversations behind closed doors, and hopefully we'll get some answers or direction from them soon. But honestly, my point of view is that we should see the Fed raise rates. We need to get the inflation under control. We need to get prices under control so that way the next generation has a chance to actually save their money. And so we're going to have to see what the government decides to do from here. Real estate market is one of the most manipulated markets out there in the financial system. The government just can't seem to get their hands out of real estate by manipulating these mortgage rates. So here's one of the things talking about mortgage rates is UWM, which is the largest mortgage lender in the United States, is just tanking in stock price. Look at this, from November 2020, they're up to $13 a share, and now they're almost a penny stock, around 1.2 to 1.4. It did recover a little bit, but their earnings have been dropping off a cliff because the mortgage demand has really dried up. In servicing, on the other part of it, is they're starting to see a lot of distress, and when there's a lot of distress, those servicers don't make a lot of money. They have to go out there and do the work to collect payments and process all the mortgages, and it becomes a lot more challenging. So we're seeing the distress show up in stock prices. You can even see this in some REITs out there now. Their prices are starting to correct, and this is going to be a story that I think isn't going to be just one that's overnight and this is going to recover immediately. I think we just could see distress in this market for the next 5 to 7 years as all this backlog processes through the system from the 2020 to 2025 timeframe, which is when the government did not allow foreclosures to really go through. They came out with these workout programs so people could lump their missing payments onto the back end of their mortgage. So for now, what we're seeing right now is this affordability crisis. This is a huge red flag. Contract signings are basically at less than great financial crisis lows. This just means that the buyers are backing off at a massive rate, as they should be, because they don't want to overpay, or they simply just can't afford. This isn't because the buyers don't exist. There's a ton of buyers who would love to own their own home, so the demand is there. It's truly an affordability crisis where people can just not make the payment relative to their wages, and they're just choosing to rent, which is much cheaper. In many cases, you can rent a similar type of property for about $1,500 less per month. And so for a lot of people, it doesn't make sense to go out and buy a house. A lot of cases, people are doubling up. They're living with their parents, things like that. So the demand is there, but the household formation is really slowing because people just aren't able to buy their first house. They're not going to start their family living in their family house. They want to have their own house. So people are delaying major life events across the board. And all of this stuff is starting to show up in the contract signings. And look, as demand drops, you see the inventory stack. So right now there's 51% more home sellers than buyers, according to Redfin data. This is a basic near record from December, 51.8%. I bet you by this December, it's going to be much higher moving forward. There's going to be a tremendous amount of sellers who do want to liquidate their properties going into the end of the year, and they're not going to catch the buyers that they thought they were going to get. And there's still some sellers out there who still think it's 2021, 2022 prices. They have not woken up yet, and so they're going to be in for a rude awakening for what comes next. But we do see the demand dropping. We do see the contracts falling through as well. So not only is demand less, but it's harder to keep a deal even together at this point. And that's when you start to see cracks. And I know a lot of people will say, well, John, there's a ton of equity in these houses. You know, there's not going to be any distress. Well, that's how it was in 2008 as well, right? This isn't some sort of magical event because you have a lot of equity that equity cannot evaporate quickly. We see this happen all the time because real estate is priced at the marginal buyer and the marginal seller and what they agree to the price. Then when you try to sell your house, even if you try to sell at a higher price, it rotates down because that sale will become a comp for the bank, for the appraisal, and it starts to kind of filter downward. And that's when you kind of see the prices start to spiral down. And we see this happen in condo communities and townhouse communities already in the marketplace, and it will spill over to single family as well. And look, this is a post that was made by Nick. You will see a ton of this. Guess who pays? So massive discount on a 2024 build house in Florida. This is what we see all day long. Owner bought it for $525 as a new build. 2 years later, it's listed for $410 as a VA short sale. This is where we're going to see the majority of the distress in the market. We're going to see FHA buyers, VA buyers, because they have low down payment. VA, you get 100% financing. FHA, 3.5%. They're buying new construction homes from 2023 to 2025, and then something happens that they have to move, and the builder moved the prices down 100 grand. They're competing against the builder who's spending up to 25, 30 grand to buy down the mortgage interest rate, and they're underwater. So what do? You have to do a short sale. So now the banks are loading up with staff to be able to process short sales. I can tell you, we get calls on short sales every single day. We have people who are underwater. They can't pay the realtor fees. Their house is underwater. They got a second loan on their house when prices were at peak prices, and they spent the money, and they're underwater. So we're seeing this left and right. There's a discount, but the bank has to approve it, right? The bank, they usually will approve 15% off, but we're talking about big amount of, that's a 22% discount. So the bank will have to decide if they're going to just miss the payments and continue to work through it or do a modification for the borrower. And so we're going to have to see how the banks are going to respond to all this distress in these pockets around the new construction communities. And the existing homeowners who live around this house get impacted too, because they're also competing against the builder. So everybody's competing against these Florida builders right now, and I think this is where a lot of the distress is going to be. It's not going to be the person who bought in 2019 before prices went up 60%. It's going to be the person who bought at the peak and now prices are down 10 to 20% in these new construction communities. And of course, that means the builders are concerned, right? So builder sentiment runs soft as affordability strain subdues their orders. Home builders continue to rely on incentives to drive sales. They would prefer to give you a $50,000 credit versus reduce the price, because if they reduce the price, it'll show up in the comps in the community, and then people say, well, I don't want to pay that price, I want to pay the lower price because this is all public record. It's not public record if they keep it off of the books, right, in terms of a credit or upgrades or other types of benefits, and they want you to see the headline numbers. So that way they can continue to sell them at these high prices and have less appraisal issues. So those who buck this trend differentiate on product and community offerings. So this builder sentiment is really bad. The consumer sentiment is all-time lows. So the consumer is feeling it, and then it's obviously showing up on the builder side as well. So this is home builders, U.S. housing starts, actually. U.S. housing starts have crashed towards COVID era levels as the housing market buckles. So the builders are noticing this. They're seeing that they're oversupplied of their inventory, and they're slowing down the amount of housing starts that they have for new projects. The U.S. housing starts plunged sharply in July, signaling a renewed weakness in the housing market and raising fresh concerns about the health of residential construction. The steep decline pushed construction activity close to the level last seen during this era downturn, highlighting the growing pressure facing builders. So builders are under stress. They're doing whatever they can. I have a lot of friends who are site agents. They tell me that they're doing whatever they can to keep their mortgage rate as low as possible because they can get people to buy if they make the payment make sense for them. But then those people are stuck in these houses that they overpaid for, and they can't walk away from it because they'll lose that rate that these builders spent a fortune buying down for them. So it kind of traps people in their house. And look, we're seeing the distress already start to show up. I think this, again, is going to not be some sort of overnight event. I think it's going to be a decade-long, a 5 to 10-year type of event where it's just going to grind lower every single year. Either wages will have to keep up, which is not a good bet. Mortgage rates will have to come down, which I don't know if it doesn't look like that's happening anytime soon. So I think we're just going to have to see prices come down, which is exactly what we need. So more Americans are having a harder time keep up with their home and their car payments. The car payments are unbelievable. The amount of repossessions that are out there right now is basically at all-time highs, and they changed their loan terms from a 5-year to a 7-year to try to make things work better for them. And then at the end of the 7 years, their car is like 80% depreciated, and then they still have a big loan on it. It's awful. But more Americans are having a harder time keeping up with their home and car payments, and it is going to spill over into the economy moving forward. And with AI coming in, that's going to make some people very wealthy, but a lot of people, their jobs will be replaced or changed, or they'll change the way that they do it. I think it could really make a huge difference. And the distress under the surface, this is what you don't really see, but we see it on the back end when there's borrowers out there with massive debt to income ratios. So the amount of debt flow, basically, if they got this mortgage, all their debt included going out the door relative to their wages is 39.6%. And after tax, that's more than 50% of their income that goes to just debt payments. That's not even what you need to actually live. So this is the debt to income ratio for new mortgage originations. Obviously, you can see that it has skyrocketed. It's usually between the 30s and the 40s, but now we're at peak level. We're actually above the 2007 housing bubble level. And I think this is, again, where we're going to see the stress right here. These folks who are buying from 2022, late 2022 to 2023, that's where the debt to income ratios are going to be kind of risky. These people already have the majority of their money, or a lot of their money, going out the door for their debt payments, and I think it's going to probably get worse. Obviously, personal savings, if they don't have money to pay their credit cards and they're defaulting on their credit cards, you can see that the credit card balances continue to go up, and their personal savings go down. They just don't have the money to save and invest. From an unemployment standpoint, you can see that the credit card delinquency is starting to move up. And the reason I bring this up is because people stop paying their credit cards. They usually try to stop paying their car. It's one of the last things. They don't want their car to get repossessed. But they generally do try to make their mortgage payments as one of the last payments to do. But the credit card's easy. It's unsecured. So that's why you see stress in the unsecured debt first and then the secured debt second. And so this is what we're seeing, right? This is a leading indicator when people aren't able to pay their monthly bills. And then we're also starting to see unemployment data kind of tick up. And one of the crazy things is that the amount of revisions that we have had over the last 30 months, I mean, the government is basically just lying to you. I mean, I don't understand. We have the technology to be able to freaking track people in their cars across the United States through flock cameras, but we can't track how many jobs have been created. I mean, it's just like, it doesn't even make any sense. But like, if you have, the labor force has shrunk by 1 million workers in the past year. A lot of people are even leaving the labor force completely or getting gig economy jobs. But the job market is not as strong as it appears under the surface. And that's kind of the message from this video is, all this stuff, we're still being pitched a housing shortage. The job market's fantastic. All this, I don't see it. I see a completely different vision of what the government is telling us and what the news is telling us, what the mainstream media is telling us, what the builders are telling us. Everybody's saying they're doing great, and then the data shows a completely different story across the board. And so obviously when you look at this chart, it's not reassuring. You look at this chart of how many revisions there are. Okay, the job market's not as strong as it seems either. And that's really where you'll see the distress. When people start losing their jobs is when they start giving up their houses because they just don't have any income to actually pay. This is really the new subprime. You can see that it's already skyrocketed up to 11.7% on these FHA loans. So we're going right back to these high levels. I think we are going to continue to see this go up as these workout programs expired and these FHA and VA mortgages come up and they need to make payments. They go to sell the house, they can't sell it. And I think that's really what's going to be the next story is these people are basically trapped in their house and they have to figure out how to get out of it, especially if they bought recently and got the low rate and they still can't make the payment. We're seeing foreclosures jump across the board, right? 39.69%, which is incredible, but it's coming off of a record low number because of that backlog that wasn't processed. So it seems like a big number now. It's not as big as you may think. It's going to be a slow drip upwards, in my opinion. I don't think it's going to be some sort of rapid event within a year. I think we're just going to have more foreclosures hit, and that's going to distress the property prices and help push them down. Now, I've been posting on X quite a bit about basically demographics or destiny. And this is a great chart. It went viral. Just wait until the green tries selling to the red and Gen Z isn't even on the chart. I mean, the majority of this housing wealth by generation is all tied up into the boomer population and older. They control the majority of the wealth in the country. It's always kind of been that way. Obviously, you're older, you have more time to make income. But what happens when all of this wealth has to transfer to the next generation, and will it transfer to the next generation? I'd love to hear from you. Do you think that money will actually make it through? Or will all this wealth, the way that it's concentrated among the top 10% of people, and they're just passing it to the top 10% kids, and the majority of people will continue to grind along the bottom? Because what drives housing is a strong middle class. It is not the top 10%. They only need one house to live in. Maybe they get two if vacating out there. But it leaves a big question of what will happen to the next generation's wealth, and I'd love to hear what you think is going to happen. So look, a lot of opinions on the horizon here. What do you see happening in the next 6 to 12 months? And if you're looking for a top real estate agent in your market, go ahead and reach out to me. We have a referral network that's now nationwide. If you have any questions about real estate, you want to get in touch with a top agent who actually knows what they're doing, reach out to us. We're happy to connect you with somebody who can help you through this process. If you're selling, if you have any issues, if you're buying, you're concerned, you want to run the math, and you can always go to the movewithmomentum.com website. We have a lot of tools and resources on there where you can search for real estate specifically in Florida, but we'll be expanding outside of Florida over the next couple months here. Thanks for following, and I'll see you next week.